If one thing is certain, it's that the results of the U.S. presidential election will continue to dominate headlines and conversations for weeks to come. I'm Mark Kinney, Chief Investment Officer at Newport Private Wealth, with your mid-quarter update. While investors often display strong reactions following election results, whether excitement or caution, historical data suggests that these reactions may not significantly impact long-term market performance. Successfully navigating through these cycles requires focusing on fundamentals and avoiding impulsive responses. This update will touch on Newport's fundamentals. We'll review activities from the past quarter that align with our strategy to protect and grow your wealth. We'll also take a closer look at the evolving economic indicators and performance drivers that are shaping Newport's perspective, such as deficit and tariff considerations, the impact of a stronger U.S. currency and its effect on the Canadian dollar, and the mid-range outlook for inflation. Equity markets broadly welcomed the election results, with a Trump victory already priced in to some extent. Reflecting a risk-on sentiment, investors shifted toward higher-risk assets like stocks away from safer options such as bonds. U.S. stocks surged, with the S&P 500 futures rising over 2% in pre-market trading. Small-cap stocks also saw substantial gains, showing support for Trump's pro-business agenda, including potential tax cuts for corporations and wealthy individuals. However, beneath this optimism, the bond market signaled caution. The 10-year Treasury bond yield jumped to a 4-month high, suggesting concerns that Trump's proposed tariffs could fuel inflation or signal rates will stay high for longer. What does this all mean? Recall that the bond market is closely linked to the Fed's actions. When the Fed announced a 25 basis point rate cut following the election, the yield on the 10-year bond immediately experienced a slight decline. This decrease in yield aligns with typical market behavior, where lower short-term interest rates set by the Fed often lead to reduced yields on longer-term securities like the 10-year bond. More importantly, this is just one indicator within a larger puzzle of inflation expectations, economic data, and geopolitical events that drive bond market movements. Bonds offer income and diversification benefits in the Newport portfolios, particularly during periods of stock market volatility. In Q3, we made notable investments in bonds, allocating over $25 million, bringing our total bond investments year-to-date to over $50 million. This followed $122 million allocation in 2023, raising our public bond weighting to about 14% in a balanced mandate. With this material position in bonds, we're ready to take advantage of market shifts to round out our exposure. Maintaining flexibility in bonds remains a priority as we enter a period where rate cuts or increases could influence market dynamics and our positioning. We've been building our diversified platform of public and private investments for more than 20 years. In addition to bonds, private debt, income-producing real estate, and mortgages provide income generation and capital appreciation. They also help to protect against market volatility. With a current 33% allocation to institutional alternative investments, we generate growth and income largely uncorrelated to the public markets. In Q3, we allocated $10 million to a New York-based structured credit manager, capitalizing on dislocations in credit spreads. In addition, $10 million was allocated to a Toronto-based commercial mortgage manager. These focused investments align with our goal of pursuing solid, risk-adjusted returns. We have also been reviewing components of our real estate investments, reducing our position in global REITs for more favorable opportunities. Turning to the equity markets, the headline is the S&P 500's strong performance, building from strength to strength through the first 3 quarters. This was driven by optimism around rate cuts, the outsized performance of mega-cap and AI-related equities, steady earnings growth, and the election results. Newport continues to add to our position in public equities, with a $34 million allocation bringing our year-to-date total to nearly $175 million. We have both active and passive public equity strategies as part of the portfolio. With broader equity participation and the continued strength of mega-cap equities, the investment committee has been selectively allocating to passive strategies to capitalize on current market dynamics. This ensures that we're well positioned for potential growth across a wide range of stocks. Looking ahead, we're keeping an eye on a few key issues. The first is the impact of an anticipated large U.S. deficit and tariffs. Given the Republican tax-cutting agenda, the new administration is likely to run large deficits. These can put upward pressure on interest rates as bond investors seek a higher premium to keep pouring money into the U.S. Treasury. Proposed tariffs would also be inflationary, at least in the near term, making it harder for the U.S. Federal Reserve to meaningfully cut interest rates. Higher U.S. interest rates strengthen the country's dollar vis-a-vis other currencies, while tariffs put downward pressure on the currencies of countries that are targeted. These currency movements highlight the importance of diversification and flexibility. As the Canadian dollar weakens, Newport is actively managing our currency exposure, taking opportunities to lock in gains as the U.S. dollar rises. As of early November, the Canadian dollar had weakened against the strengthening U.S. dollar, trading below 71 cents. This decline reflects Canada's economic exposure to weaker commodity prices, global uncertainties, and lower bond yields. Newport's strategy accounts for these risks by diversifying our portfolios across 13 asset classes, as well as holding an 8% cash reserve. The reserve is funded by cash returns from existing investments and from new clients seeking a secure haven for their assets. Cash on hand gives us the flexibility to protect client capital against potential market disruptions while seizing opportunities as they arise. Inflation remains an important number to watch. In response to easing inflation, the Bank of Canada reduced its key interest rate by 50 basis points to 3.75% in October, marking the fourth consecutive rate cut. This reflects confidence that inflation is returning to the bank's 2% target. Conversely, in the U.S., the latest inflation numbers show a slight increase, with consumer prices rising faster than expected in September. While costs for shelter have eased, other prices remain sticky, suggesting the Fed's 2% inflation target will be more challenging to achieve. Despite disappointing job numbers in October, a stable unemployment rate and robust stock market performance suggest continued resilience in the U.S. All eyes will be on the U.S. economy in the months ahead, and our investment committee and specialty managers will continue to position our portfolio with a view to achieving our long-term investment goals. As the dust settles following the U.S. election, it's important to recall that Newport has been managing through these types of cycles before. Macroeconomic conditions, such as interest rates and overall economic growth, play a more significant role in influencing market performance than the outcomes of elections themselves. While there's uncertainty about what a second Trump presidency will look like, we are positioned for a range of outcomes. Our goal remains to balance gains with protection, ensuring stable growth through all market conditions. We're selective with investments, build liquidity for challenging times, and let cash grow as needed, all while staying steady in our approach. Newport is dedicated to safeguarding and growing your wealth. We thank you for your continued trust and look forward to guiding you confidently through the remainder of 2024 and beyond.